All right, Griffin, I want to jump to this Yardi report. It's their U.S. Multifamily Outlook for the winter of 2026. We cover these Yardi reports high frequency here on the Gray Report. This is a little bit different because it's a little bit more forecasting than just historicals. And I really marked it up because I thought there were a lot of interesting insights. And I don't want to just read all of my notes here, but there's a lot to talk about. Weak performance in 2025, and the expectation is we're going to have weak performance going into 2026. Same thing that our report is putting out there. I think the big question is kind of when things might just start to turn around. I think some folks are putting that in like the latter half of 2026. Mm-hmm. Some other folks are putting it really closer to maybe 2027, mid 2027. Yardi, really kind of puts it, a little bit further out, closer to 2027 than 2026. They are forecasting rent growth of around 1.2% for national rent growth. That's a little bit above what we forecasted in our national rent report of about 0.89% national rent growth. We'll see, who comes out a little bit closer to being accurate. I kind of hope Yardi does.
It's good to see some optimism.
It is
coming out of somebody so reputable.
And I would say if you're ever questioning, I guess our intentions. I feel like I'm speaking to my father-in-law 30 years ago, but speaking about our intentions of putting out research reports. Yardi has much more aggressive assumptions for our target markets than we do. So
yeah, they've got Indianapolis in here on the podium.
Yeah, in talk we can basically the top four potential markets for rent growth. Almost all of them are in the Midwest, and as you mentioned, they're projected to grow a little bit higher than what we were projecting. Yeah, according to the Matrix forecast, so Boston and DC are actually projected to lead rent growth. Those are prime examples of primary markets, big markets. Also, a good amount of regulatory burdens. At 2.1% year-over-year rent growth is the projection, followed by Indianapolis and Kansas City, both at 1.9%. Then Columbus and Detroit, both at 1.7%. On the other side of the spectrum, some of the largest rent declines are going to be in some of those same markets, including Austin, Charlotte, and Phoenix. And I do also like they put some of the cumulative rent declines and rent gains over the last several years. Mm-hmm. Some of the biggest decliners since January 2023, again, Austin, negative 12%, Phoenix, negative 5.7%, Pensacola, negative 5.3%, Dallas, negative 4.4%, and Tampa, negative 1.5%, with the strongest have been Twin Cities, 23.6%. Now, if you included through 2020, Twin Cities would be knocked off that list, just FYI. The Kansas City at 16.8, Chicago at 14.8, Indy at 13.4, and Grand Rapids at 12.4. So a big contrasting difference comparing the Midwest to the Sun Belt. And then getting into some of these deliveries, as we've mentioned, we're going to see deliveries slowing in many markets, but still going to be at elevated levels in others. Again, Orlando is still going to be delivering in 2026 4.1% of its existing inventory. Dallas is going to be delivering 3%. Phoenix, 4.8%. Charlotte, Charlotte's going to be delivering 6.4%. Going to be delivering around 16,000 units. That's compared to markets such as Kansas City, that's going to be delivering 2%, Columbus, Ohio, delivering 3.3%, in Indianapolis, delivering 1.1% or 2,300 units. Overall, much healthier supply levels that we would expect to normalize those markets a little bit quicker than some of those Sunbelt markets, which are most likely going to see just kind of over the next couple of years, rent growth just being drug down.
You said it in our kind of pre-show conversations, pre-podcast conversations. This report's indicative throughout each paragraph of continued Midwest leadership. I think you used the word dominance. I'm going to use the word leadership in the multifamily sector. It's encouraging to us at Gray Capital. I'm curious as to operators that are in some of these markets in the Sun Belt, how they're viewing this report. Are they kind of scurrying in 26 to amend and kind of redirect investment strategies, or do you think they stick to their guns?
I think they're going to stick to their guns because I don't think they have much of a choice. I think they're going to point to supply coming down, relative to 2023 supply, but are going to maybe downplay that there's still a good amount of deliveries that are taking place. They're also going to be highlighting the really strong demand. Demand is incredibly robust throughout the Sun Belt. That's the reason why all these properties were built there.
Right.
It's because of the strong demand, good population growth. There are questions on the impact of immigration, the overall multifamily industry, its impact of population growth, less immigration, less population growth, less pressure on rent, especially in the bottom half of like the spectrum, but it affects the entire industry. So you have maybe a little bit more immigration pressure in the Sun Belt. And so if immigration levels have receded a little bit, do you have a little bit less pressure? But a lot of the, the growth story from the Sun Belt, not just immigration, it's everyone from everywhere is migrating to the Sun Belt for affordability, quality of life, the weather.
Right.
Us in the Midwest, we understand that right now because it's really cold. But the affordability, that's starting to lose some traction in the Sun Belt as everyone from California moves to the Sun Belt. Well, the California wherever they are now, and the prices go up, and that's leading the Midwest to appear a little bit more affordable.
Yeah,
it is fascinating, Griffin. You were talking about this before the episode, that even with all the we're looking at the metrics, and there's going to be slow rent growth in the Sun Belt. A lot of apartments are still going to be built there. That's where investors are still continuing to choose. They're doubling down. In the report from Yardi, investors continue to favor growing Sun Belt and secondary markets per matrix. The volume was highest in Phoenix and Dallas, and Seattle and Miami and Atlanta. But then saying liquidity is still present in primary markets like Chicago and Boston. You were just asking this question earlier. Are operators changing their strategy, or are they going to kind of shift? And investors clearly aren't changing their strategy. I think that they've drunk the Kool-Aid, and I've heard the saying that if you've made your mind's made up on something with one piece of information, it needs to hear the reality or alternative facts 10 times over before they're open to changing their mind again. And I think that's the case with the Sun Belt, where I'm committed to that thesis of investing in population growth and demographic shifts to southern states. Makes a lot of sense. The next step is that can be true, but relative to supply, it may not be the best investment thesis over the medium term. Long term, it makes a lot of sense. You pick up an A-class property in Austin, Dallas, Charlotte, you buy it at a decent price that can cash flow. I think you're going to be in a really good spot. I think the key piece there is cash flow. And with negative rent growth, it's harder to underwrite strong cash flow in future years. Mm-hmm. So where all this is going, I think, lines up with the John Burns Research and Consulting CRE Daily Feed and Greed survey, talking about potentially lower prices in the early parts of 2026. It also lines up with our forecasts and some of our call-outs, is that there's going to be some attractive entry points. And because we can't project a lot of rent, so we can't get aggressive on pricing.
Right.
So that's going to not necessarily bring prices down. It could in some markets, probably should in a few, but if anything, it's going to act as like a ceiling on price. It's going to limit how aggressive folks can be. And so if you're an investor that's medium and a long-term holder, you can get in at a good entry point, pay for, zero to low rent growth in 2026, but then reap the gains of positive rent growth in subsequent years. And you don't have to know if it's going to come in the latter half of 2026 or in 2027 or by 2028, which Yardi Matrix expects, rent growth to get up to closer to around like 3.8%.
Yeah.
And I think that's one of the biggest call outs, or one of the interesting pieces that I saw in this report, is that they are projecting rent growth to get up to almost 4%, over time. I think the question is, again, is that 1 year, 2 years, 3 years until we get to that level of rent growth? And every market, it's going to be a little bit different. But the key here, as we've said time and time again, is buy for cash flow and buy with a medium to long term hold horizon, and you're not going to be in a bad spot.
Right. Be just curious, and maybe this is a great time to shout out a kind of a desire for different perspectives on the Gray Report podcast of different operators in different regions of the country. How are you guys underwriting new acquisitions relative to rent growth? I'm just thinking here at Gray Capital, we're somewhere between 5 to 7% vacancy in some of these oversupplied or more saturated markets. What does that look like? Do you think operators are underwriting, vacancies larger than 7%?
I think that they're assuming that things are going to recover sooner than they actually will. I mean,
it just seems like when we did the report last week, we also forecasted vacancies in some of these markets where we have these 500,000 units that are still in lease up, and those are some outliers in the data, but vacancy rates are continually kind of expanding across the U.S. And would just be curious as to what an underwriting model looks like with negative or flat rent growth year over year
what's tough is
vacancies.
The challenging part about it is, let's say we're bottoming out, which you can only have so much confidence in. I think that given supply levels, I think we're close to the bottom of occupancy or the peak of vacancy, however you want to describe that. Apartment lists, the vacancy is at its highest level since 2017, which doesn't go back that far, but still, vacancy is really high. And so it would be reasonable, if we're at the peak in vacancy, to assume that vacancy will improve over time. But that's challenging to go to investor and to improve those assumptions and to decrease vacancy over time. To say I think that it's actually going to be down within the first year. It can be a little bit of a leap.
We get that all the time. We'll jump on a call with an investor that wants to dive into underwriting, and we'll mess around with the buttons on the computer, and we'll flatten out rent growth and increase vacancy just to see what it does to overall return metrics, and essentially try to break the model. You can sit in that model all day and tweak it and see how ugly and nasty you can get the deal to look. But at the end of the day, we talk about this regularly. Do you trust the operator? Have you looked into the market? What's the growth story? What's the story of the asset? Is there a repositioning strategy here? There's a lot that goes into it more than just vacancy and rent growth.
And if everything in the business plan doesn't go according to plan, if you can't achieve those premiums, what are you left with? What is that cash flow? Is it still positive? It's not going to. It doesn't have to look really great. I mean, it's rare, and it can happen that everything doesn't go the way you planned. It's still a good deal. It's rarely a good deal, but you want to. Do you still lose money? How much money do you still make? Are you still cash flowing? If you're still cash flowing to a level where I'm not going to be too upset about that. I'm not going to be like bragging to my friends about it, but it's a lot better than being punched in the face.
Right.
I'll take it. I mean, that's where we are when I'm like, okay, we business plan fails for one reason or the other. Cap rates expand. All these things go the wrong way, and then I look at the IRR and it's a 9, it's a 10, it's a 12. I'm kind of all right with that, especially if it's a 12, because I've seen operators pitch real deals that are fully baked at 12, 13, 14. So I'm like, okay, well, our deal that's a 15.5, 16, if we just miss every single mark and it's a 12, I don't think that that's a horrible outcome, especially given like the long-term average of like the stock market. We're still kind of beating that average, even though the last couple of years it's been up like 20% or so.
Well, that's where the buckets come into play. As an investor, you need your buckets and obviously your different return and risk profiles.
Yeah. So one piece that the report also touched on, the Yardi Matrix report, was capital markets activity, but specifically looking at some potential distress. In 2026, there is roughly $90 billion of multifamily debt that is maturing. A lot of it is CMBS, but a lot of it is agency and regional banks, private banks. There's not a lot of evidence to say there's going to be widespread distress. A lot of these lenders have been working with borrowers, and it says in this report that a lot of the regulatories have been much less stringent on what the banks need to do. They're giving a lot of wiggle room, a really long leash, kind of, hey, just make it happen. We don't want a lot of distress in the banking system. You guys just kind of believe whatever you need to believe until we get to the other side of this. A lot of this distress is being worked out privately, kind of behind closed doors, and that's evidenced by a huge increase in mortgage originations. Mortgage originations rose 73%, increase in multifamily mortgage production, but transaction volumes were up, according to either Yardi Matrix or Newmark, anywhere between 9 and 12%. So a lot of people are refinancing multifamily mortgages. Not a lot of people buying new properties and needing those multifamily mortgages. And so there's a lot of capital that's been brought in. There's also just been a lot of preferred equity that's been put in kind of as a bridge to get it to wherever it needs to go before another capital event can take place. Griffin, you asked a question, earlier on, what are operators, going to do?
Yeah.
If you've had a deal, not just the bridge loans, that were bought at the peak, but what about like the regular deals that it's time to cycle out of?
Yeah, sure.
You may rephrase that question the way you were saying.
I'm curious. There's operators that whether they acquired a single asset or they have funds that were acquired. Let's just say back in 2017, 2018, the equity was told up front, hey, this is going to be a 5, 7 to 10 year hold. Just depends on how it is. That we're nearing that disposition timeline based on projected hold period, and so there's these operators that are being not forced to sell, but their equity is looking to recycle just based off of previously expressed hold periods in what is probably not a most advantageous market to sell an asset. What are some of these operators going to do because they're unable to likely get the valuation of that asset that their equity would like to see, but also their equity is looking to recycle. So what's the optionality there? Will we see deals come out that are great deals we can essentially buy at fantastic entry points just because the runway for that fund or runway for that operator and that single asset is kind of run out?
It's an interesting problem that's not just a real estate problem, because we're seeing this take place in just normal, regular private equity right now, where there's the rise of these continuation vehicles, where in the past, these continuation vehicles have been more for like troubled assets that they don't want to realize losses, and they say, hey, give us a couple more years to season like the operational performance of these assets and kind of kick the can down the road. Today it's more today those deals are suffering, but more that's happening today is there's these high quality assets that, again, whether it's a business or it's a piece of real estate, and the GPs are saying, hey, we don't want to sell this thing and break even right now. We have a ton of carried interest to promote that we're counting on getting out of this asset. We've put all this hard work on over the last 5 years, 7, 10 years. And just because in our offering document says that 2026 is the year that we need to sell, we shouldn't make a forced error and just sell it when the market is down. I mean, it's buy low, sell high. It's not buy in the middle and sell, low. Yeah. I mean, that's just not basically the way that you make money. And especially if you have a high conviction that we're going to be in an improved capital markets, improved environment to sell in a medium term, not 10 years, but call it 1.5 to 3 years. There's a good case to say, hey, grant us another extension, or I'll give you an option. Here's the door. You're welcome to take it.
Right.
And you'll be maybe you have to leave it a little bit of a discount. Maybe you have to leave it just at par right now. You're not going to make that much money, but if you need the liquidity, which a lot of investors are asking, hey, I need liquidity. I need to cycle this out. I have other opportunities, or I just want give me my money back. It's been too long. Hey, if you don't believe in it, here's the door. But if you believe in it like we believe in it, come along, stay on the train, stay on the bus. We're going to take this thing another 2 or 3 years, and we're going to seek an exit at that point where maybe the IRR isn't going to be as attractive, but you're going to be able to get that multiple at the same, similar, maybe even a larger multiple. And that's where, again, IRR, it's what's the most talked about metric. We use it to compare. It's not a bad metric. I don't hate it by any means. I think it's a useful metric to compare things to. But cash flow and multiple, I think, are the absolute best metrics in terms of gauging your return. Because your cash on cash yield just annually, how much cash am I putting into my pocket based on that amount of money I put into the deal itself. And then that multiple is, how many times have I made how many times have I multiplied that capital? And it's many investors saying a rule every 5 years. I want to be doubling. If I'm doing better than that, I'm doing above average, below that, probably below average. And so giving ourselves a little bit more time, you should be able to, amortize more debt. You should be able to grow revenues and get to a higher multiple. And so again, as like a real estate investor, okay, so if I could sell this deal today, it wouldn't be a huge win. Maybe be a little bit of a win. But I could maybe sell it today and have a higher IRR, but then if I sold it 2 years from now, but my multiple might be significantly more in 2 years.
Yeah.
And so it's like, well, do you want a 30 IRR versus a 20 IRR? But if the difference for getting the 20 IRR is a 3x multiple versus a 2x at a 30 IRR, if that makes sense. I think if we're just talking 3 years and not another 5, I think I'll take the 20 IRR and a 3x. So I want to triple my money, so then I can go and try to double it or triple it again and get the power of compounding.
Right, that's interesting. It's a kind of a short-term solution, for those investors that otherwise don't have those liquidity needs. It was interesting. I just kind of generated this concept sitting here across from the table from you today, and I thought for certain that maybe we would see some of those assets, or maybe even just a portfolio sale, come across our acquisitions desk, or have the opportunity to buy just based on some of the liquidity needs that we've seen in the markets more recently than not. But if there is the kind of flexibility and creative solution of putting together somewhat of a shorter term hold vehicle to encapsulate that asset, encapsulate that fund, preserve its value, not kick the can down the road, but provide a little bit more patience to then see that multiple on the back end for those folks that have the optionality of being patient. It's an interesting solution to that problem.
Here's what's frustrating, Griffin, and you're not going to like to hear this. I mean, in our markets that we're targeting, going back to multifamily in the Midwest, we're probably going to see the least amount of great opportunities to buy. They're going to be very targeted. You're going to have really good relationships, like we do. But there's not going to be huge discounts.
Yeah, no fire sales.
There's no fire sales because we have just the market's is in balance and we have positive growth. And there's going to be fewer people who are going to capitulate, and you have any reason to capitulate because there's a story there. If I'm a developer, like the developers we know that are kind of underwater right now in terms of valuation or where debt is, but they're like, look, we're going to be able to grow rents over the next couple of years.
Yeah.
Okay, shift to the Sun Belt. I can't grow rents. Those are the deals where you might capitulate and say, guys, look, 3 years ain't going to fix this problem. We just have to sell now. We have to sell at a discount. We're being forced to sell. And so I think it's going to be more regionally focused where that distress is. It's probably going to be more down in the Sun Belt, or in the Mountain West, maybe Denver, Phoenix, rather than the Midwest. But again, you have to factor in just because you're buying at a discount and it's distress, that doesn't make it a good deal inherently. You still have to have a good performer, a good business plan that, lines up with reality.
Right. That makes a lot of sense. Buying the asset on its future value here in the Midwest, when you see all these headlines, rent growth is going to be positive, where in the nation, kind of across the board, will be negative. I can understand why there won't be those fire sale deals.
Even from a national perspective, going back to the Yardi report, and talking about delinquency and distress, it's much more lower than people think. I mean, the highest is in CMBS delinquency, and that's coming up at 7% right now as of October of this year, which is the highest rate since 2015. But, CMBS is a relatively small percentage of the overall market. The more than 50% are the agencies, and as of mid-year 2020-25, according to the Yardi report, the delinquency rate was 1.3% for commercial banks, 0.6% for Fannie, 0.5% for Freddie, and 0.5% for life companies. So That's not exactly painting a picture where there's a ton of distress. Again, not that there isn't distress, not that there aren't foreclosures, not that there aren't people losing money, and there's a lot of people who aren't making the money that they thought that they would make, but there is a lot of resilience that multifamily has shown over the last couple of years. Even in these high supply markets, at least the capital markets have buoyed them up to kind of keep them going, because there is just long-term thesis that still makes sense. People are going to need a place to live. The population is growing in these, all across the country, but especially in the Sun Belt. And it's worth not having these assets fail. So I think it's been a pretty interesting case study the last couple of years, for running a lot of insights nationally, locally, regionally, and more.